and welcome. My name is Tyler Wood. I'm a CMT charter holder, and today I am joined by Alex Cole, the creator of GoNoGo Charts. How you doing, my friend?
Doing well. Always excited to do a little educational material.
Absolutely. So for all of you Chart IQ users out there, you've probably already watched our video on trend identification. We're going to continue this series to help explain some of the tools in GoNoGo Charts. Now, to get us started, we gotta think about what our goals are as technical analysts, and it starts with a disciplined, repeatable process. You heard us talking about a checklist, having the weight of the evidence behind us. When we're thinking about our technical tools, we want multiple confirmations from multiple sources before we make a trade decision. So that concept applied to the trend identification video helps us understand price action and trending in those colors of the GoNoGo trend. Today, we're going to turn our eye to the concept of momentum, the first confirmatory indicator that we can use in conjunction with our trend analysis. So Alex, talk to us a little bit about the basic concept of momentum and some of the tools that we could look at.
Yeah, and as you just mentioned, it really is the next piece of the puzzle. When you're a technical analyst, after doing some trend identification, you're most likely going to turn to the study of momentum, because oscillators give us such valuable information about price movements. We like to talk about measuring the velocity of price movements. And when we do that, we can get a real sense of the health of the movements that we're seeing in price, whether they're likely to continue or whether they're likely to pull back towards some sort of mean. Now, we can look for areas of extreme swings using overbought and oversold levels. And we can also get a sense, as I said, of how a trend is faring based on the strength of price movement. But as I hope you can see, the chart quickly becomes complicated. And what I'd like to mention is, imagine if you added some of these indicators to that trend identification chart that we built in the last video. Now you've really got something that perhaps could be overwhelming and really could inhibit decision making.
But the conjunction between trend identification and momentum is really useful because momentum oscillators, by their very nature, are forward-looking. We're deriving these indications from price and volume data to help us understand the leading indication, a potential moment of exhaustion or acceleration, to help us understand the trend direction, velocity, and durability. So Alex, let's dive into a few of these one by one and just explain the construction of the momentum oscillators.
So the first we're going to talk about is stochastics, very popular indicator developed, of course, by George Lane in the 50s. And what stochastics does in its calculation is compare the current closing price to the highest close within a range. Because the idea then is, if price is higher than the highest close we've had in a set range, then we can get a high value for momentum. In this case, for the stochastics reading would be high if that price, that current price, is the highest high of the range, or very high relative to the highs of the range. And we know that the components of the stochastic are multiple lines. The two most used are the %K and the %D. And the interaction between those two lines give us signals. They give us crossovers. So when the faster K line is crossing over the slower D line, we can expect price to move perhaps in that direction in the short term. And we also know that with something like a stochastics, we're going to look for areas of overbought and oversold. And with stochastics, those are typically defined at the 80 and the 20 level. So when we get above 80, we would consider that overbought, and below 20, we'd consider that oversold. But remember, with stochastics, it's all about comparing the current price to the highest prices in the range.
Absolutely. And you can see in these areas where we have price gains, trading is moving to the upside before our trend identification changes colors, gives us a different context for the trend of that security. So in terms of using momentum oscillators to help you find earlier entries into trending securities, that is the idea of these forward-looking mechanisms. Let's talk about another of the most popular indicators out there, the RSI, the Relative Strength Index, not to be confused with the concept of relative strength, evaluating one security or asset class against others. But the RSI was created by Wells Wilder and introduced to the financial industry in 1978. Now, just think for a second about what U.S. equities markets were doing in the 1970s. This was a brutal range-bound bear market. And the idea behind RSI was looking for those areas of overbought and oversold to help us find points of exhaustion and potentially mean reversion. That was the original use case for RSI. Unlike stochastics, RSI is going to generate just a single value. That's one line, not two. Those white and red line crossovers that we saw in the stochastics don't exist here. Instead, we're looking at changes in the reaction to the latest price bar. So RSI is constructed by looking at a computation in which the average gains are divided by the average losses over a specified period. Typically, that's about 14 days or weeks or minutes, whatever time frame you're looking at. Now, you're going to see higher RSI values when the recent price action has been dominated to the upside. RSI is helping us capture that market behavior to identify overbought or oversold levels by predicting those points of exhaustion or expansion. And like other oscillators, RSI is going to fluctuate between 0 and 100. Again, as Alex said, typically a reading above 70 is going to denote those overbought levels. But what about 69 or 71? There's some interpretation there. There's some subjectivity to an arbitrary number on these oscillators. And it's in the hands of the individual investor or trader to interpret whether a signal below 30 is oversold, a signal above 70 is overbought. And the other important thing to point out here is that many traders have been caught in this trap of seeing an overbought reading in something like RSI and assuming mean reversion. Remember, these are leading indicators. They are not what we use for trade decisions. It's simply to help us understand the context and the nature of price trend. So repeated overbought levels in a persistently trending security is actually a good sign. So we don't sell as soon as it gets to overbought or buy as soon as it reaches oversold. Alex, let's do another one. Let's dive into the next.
Yeah, and another point to mention about overbought and oversold levels, we'll see those here as well, is that people will change those based on assets that they're looking at, based on securities that they're familiar with. So very subjective, as you mentioned. But money flow is the next one that we're going to talk about. And this one is characterized by its incorporation of volume. So each of these are coming at momentum with a slightly different slant. And that's what fascinates me about the money flow index. And that's why that it's one that I always like to look at, because it brings volume into the equation. And the way money flow works is if there's a higher price, they use a typical price, which are 3 of those OHLC data points divided by 3. If that price is positive, if it's higher, then we will multiply by volume and add it. If that price is lower, we will multiply by volume and take it away. So you can see in this example here, we get a sense of positive and negative money flow by the way the line rises and falls. Tyler, you mentioned divergence on the last slide. Well, we're going to talk about that a little bit here, because on so many of these oscillators, the concept of divergence is so important. And this is an example where you've got higher highs in price, but lower highs in the money flow index. So what does that really mean? It just means that there's more volume associated with lower prices, with prices that are moving lower. So that's a little bit of a cause for concern if you're thinking that that bull move is going to continue. So very, very important as well. Now, we also can draw overbought and oversold levels on here, but we have to be careful because we are going to bring in that subjectivity once again.
So you can think of the money flow index as volume-weighted RSI. We know the importance of tools like volume as a confirmatory indicator, and to embed that within our momentum oscillator can be a really helpful insight into market exhaustion or expansion. Let's do another one. Let's talk about perhaps the simplest in terms of construct tools that we can think about, and that's the rate of change. Now, it's simply measuring the momentum by looking at a percentage change in price between the current bar and a specified look-back period. Now, unlike other oscillators, the rate of change indicator is going to plot a range starting at 0 and moving into positive or negative territory, depending on the price movement over the look-back period. Now, in addition to generating convergence and divergence data, those crossovers of the 0 line can help us find important buy and sell signals. Now, rate of change values are unbounded. That means they can go well above 100 or well below negative 100. And just to help us illustrate the point, I'm going to thank our Reddit subthread investors in the meme stock mania. GameStop, if you remember, reached 1,800 on its rate of change during that historic 2021 short squeeze. So an unbounded indicator, it is exactly that. We can see these exaggerated values, which again gives us some challenges in terms of how we interpret where we see overbought and oversold, where we find exhaustion. As they say, the market can behave irrationally much longer than we can remain solvent. So a rising rate of change above the zero line is going to confirm our uptrend within the applied settings and time periods. And a falling rate of change below the zero line is going to give us confirmation of a downward sloping trend line. And that range-bound territory that we were talking about that Wells Wilder was trying to deal with, if we're in a range-bound market, this rate of change indicator is just going to bounce around the zero line, which basically destroys a lot of the utility for the tool. And finally, a quick word about divergence that we just highlighted on the last chart. These are leading indicators, and they're not trade decisions, right? They help us understand the velocity and durability of price action. And in short, they're not infallible. And so here we're seeing a bearish divergence on this upward sloping price action. We saw a lower high in the rate of change. But of course, that did not precede a major drop-off here on this daily chart of the S&P 500. We instead saw prices rally. So just keep that in mind when you're thinking about divergence analysis. It's a leading indicator and a way to give context to our interpretation of the price action. All right, Alex, let's do another one.
Yeah, so the last one that we've got here we're featuring is the commodity channel index. Another interesting one for me because it attacks the idea of momentum in a slightly different way again. So this indicator measures momentum by comparing current price to a historical average. So you get a sense of how far away has price moved from its average. And that gives you that sense of whether or not we could be looking at exhaustion. Is price overextended? And it oscillates above and below zero, as ROC did. Also, like ROC, it's unbounded, which can bring in the challenge of being subjective with your levels of overbought and oversold. It becomes arbitrary. You can see even on a simple chart of the S&P, which trades fairly sensibly, you can get overbought readings up to 300. So where do you set those overbought levels? Do you set them at 100, which is quite common? But how do you know when you've really got to overbought? You're going to be then tweaking the indicator based on price volatility. But do we feel comfortable doing that, by looking at each security and looking at how volatile price movements are? Do we feel confident that we can set those overbought and oversold levels in the right areas? And so that's one of the problems that we bring in with an unbounded indicator, as we saw with ROC.
Absolutely. So let's come back to our initial slide, right? Bringing it all together. We know there are many trading strategies out there that have 2 or 3 or 4. I don't think I've seen too many that are using 5+ momentum oscillators. But here's our challenge, right? We have to choose which ones we're going to use at the detriment of losing the data from the others. And more importantly, when we stack the checklist, multiple momentum indicators, we start to see the price panel shrink beyond recognition. We can't see important areas of support and resistance. We can't analyze price action itself because we've got too much clutter on our charts. So I want everyone to write this down in their notebooks. If there's one takeaway from today, it is that Alex and I will forever be indebted and are extremely appreciative of all of the work from the technical analysis community that came before us. George Lane, Wells Wilder, a lot of the innovators, the men and women of Wall Street who also interpreted and applied a practical use to these momentum oscillators. Folks like Connie Brown and Andrew Cardwell that helped us understand how to use them in current investment regimes. That work is invaluable. But the concept of GoNoGo Charts is that we want to capture all of the information, but handle the heavy computation in the back end, so that we can simplify our data visualization and declutter our charts to avoid that analysis paralysis, that subjectivity that many critics of technical analysis point out. Yeah. So Alex, let's talk about the solution here with the GoNoGo oscillator in that lower panel.
So this is the end result. Like you said, we couldn't be more appreciative of what's come before us in terms of people that have created these tools and shown us how to use them. But we want to get the information, the valuable insights from those indicators, but distill them into something that is still easy for us to read and interpret on our charts. And so what we have is one oscillator that blends some of the foundational concepts of momentum and some of the most robust tools into one line. And with that line, we can still do traditional momentum analysis. We can find areas of extreme overbought and oversold levels. And you can see how when the oscillator gets into an extreme, in our case, above five or above the zero line, or -5 and below for downward moves, those are our extremes. And our indicator just goes from -6 to +6. So we want to keep the readings simple as well. And you can see how they line up with the peaks and troughs in price. The other concept, we've talked about it several times today, that's so important, is that of divergence. And yes, with the GoNoGo oscillator, you get that information as well. So you get a higher high in price here, as we saw with some of the other indicators, matching up with lower readings in the GoNoGo oscillator. So easy to identify. We get all of the information that we need from momentum, but we keep price at the forefront. You can see how large that price panel is. You can see on the right side how clearly we broke higher above those prior highs after an area of consolidation, because the price panel is nice and big and we don't have anything else on there to diminish its importance.
Absolutely. And the final piece of the GoNoGo oscillator that we want to point out, we're firm believers in cramming as much information into a simple to read chart as possible. So we have incorporated relative volume right into the GoNoGo oscillator. The simple color change, where we are in this light green, we have lighter volume. And where we move to this dark blue, we have heavy relative volume. So when we think about using that confirmatory indicator that Charles Dow shared how important it was over 130 years ago, we can embed that right in the chart without adding additional histograms and additional tools to our chart that can clutter our analysis. So thank you very much for sticking with us through today's educational video. For all of you Chart IQ users out there, we look forward to seeing you again on the next installment here from GoNoGo Charts. If you have any questions, don't hesitate to reach out to Alex and I directly, info@gonogocharts.com. And until next time, be well, stay safe. We'll talk to you soon.